Hi ladies and gentlemen, welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Hi everyone, and welcome to this webinar on Section 20 of the IFRS for SMEs dealing with leases, and this webinar is presented by Anton van Wyk. So welcome to this webinar today. As I said before, we're dealing with Section 20 on leases, and of course in the IFRS for SMEs, not full IFRS. In full IFRS, we know that there's a brand new IFRS that's been released on leases, and that is IFRS 16. And the very last slide of this webinar, I'll just quickly speak about IFRS 16. So what I want to cover today is an introduction to Section 20 on leases, determining whether an arrangement is or contains a lease. So we have to be careful that something does not have to be called a lease in order to actually be classified as a lease in terms of the IFRS for SMEs. How we then classify those arrangements or agreements that we see as leases after taking cognizance of point number 2, the accounting treatment of leases in the financial statements of both lessees and lessors. Just a quick recap on sale and leaseback transactions, because those are obviously transactions that don't occur very frequently. And then the deferred tax on leases, and also quickly sale and leaseback transactions. And then, as I said, right at the end, I would like to give you a glimpse into IFRS 16 on leases, just so that you can see what the developments are regarding full IFRS, because we do believe that those full IFRS developments will be, finding itself in the future versions of the IFRS for SMEs, especially in respect of leases. So I'll just give you some exposure there right at the end. All right, so starting off with an introduction to Section 20 on leases, we can see that Section 20 deals with leases. The scope is quite important. We need to know what a lease is and also how a lease is identified. So what is important there is that something doesn't have to have the header that says lease agreement before it will be a lease. So we need to look at what those identifying factors are that would make something a lease within the scope of Section 20. And I think that's quite important for us to focus on. Then, once we know that we're busy with a lease, how do we classify leases between finance and operating leases, and what the indicators are of possible finance leases? Then we'll be looking at lessees, looking at finance leases and operating leases, lessors, finance leases, manufacturer-dealer lessors, and operating leases. Why we look at manufacturer-dealers separately is because there are a few principles that we have to take into account. The fact that someone has selling profit from being a manufacturer, but also earns interest from the leasing component. And then lastly, as I said, sale and leaseback transactions, a quick recap when they result in finance leases and when they result in operating leases. All right, now the leases that are excluded from the scope of Section 20 are, again, those leases that are treated in terms of other sections of the IFRS for SMEs. So we just need to be cognizant of the existence of these exclusions. Firstly, leases that we enter into as lessee or lessor to explore for or use minerals, oil, natural gases, and similar non-regenerative resources, because Section 34 on specialized activities in the IFRS for SMEs will deal with those leases. Licensing agreements for items such as motion picture films, video recordings, plays, manuscripts, patents, and copyrights, those are effectively dealt with in terms of Section 18. All right, so those licensing agreements do not form part of the scope of Section 20. So even if we give someone the right of use of those motion picture films and video recordings, etc., those types of intangible assets we have to deal with in terms of Section 18 and not in Section 20. Then very important when it gets to property held by lessees, remember a lessee can also lease out a property again and enter into a sublease with another lessee. So such a property is then held by the lessee for the purpose of earning rental income. And therefore, that will be an investment property of the lessee. Now, the measurement of that investment property is excluded from the scope of Section 20. And then the measurement of investment property provided by lessors under operating leases. Why only operating leases? Because if it's a finance lease, the lessor derecognizes the actual asset that is being leased to the lessee. So therefore, the lessor can only treat those assets that remain on its balance sheet. For example, the building or the land, etc., as investment property. In the measurement, whether it's the lessee or the lessor, the measurement of investment property is dealt with in terms of Section 16 investment property. So that's very important. Then measurement of biological assets, once again, and I've underlined that for you, the measurement of the biological assets held by lessees under finance leases and provided by lessors under operating leases. So again, Section 34 will then determine exactly how those biological assets will be measured. All right. But the rest, remember, accounting treatment doesn't only consist of measurement. Accounting treatment consists of recognition, measurement, presentation, and disclosure. So when measurement is excluded from the scope, that means recognition, presentation, and disclosure will still be dealt with in terms of Section 20. So if we talk about the biological assets, obviously the lessee will still recognize the biological assets in terms of Section 20, do the necessary presentation on the face of the financial statements, and also the disclosure in the notes to the financial statements. The same with the lessor under operating leases. And then lastly, the moment that an operating lease becomes onerous, immediately Section 21 takes over that lease, because that lease is onerous, and hence a provision for that onerous contract in respect of the expected loss that is made on that contract, or expected to be made on that contract, that must be provided for the moment that that contract becomes onerous. So if we're dealing with operating leases and we know that these leases are becoming onerous, for example, we are leasing our head office building in terms of an operating lease, and then we decide to vacate the premises, but we have to then say, well, we're either going to cancel this lease now and pay a termination penalty, like an early termination penalty or something like that, or we are carrying on and trying to maybe sublease the building. If that is a possibility, then we need to say, what is our expected loss? And then we say the least net cost of exiting that contract is then provided for in terms of Section 21 as a provision for an onerous contract. So the moment that contract becomes onerous, we take it out of the scope of Section 20 and deal with it in terms of Section 21. So the important areas in Section 20 are therefore the definitions that we're going to have a look at, how to identify a lease, how to classify identified leases, what lessees should be doing in terms of finance leases and operating leases, what the lessors should be doing in terms of finance leases and operating leases, and also being careful when the lessor is a manufacturer/dealer lessor. The sale and leaseback transactions, and then we're also going to have a look at the tax. Now, why we look at tax is because if we don't quickly recap the tax on the leases, then we cannot effectively look at deferred tax from an accounting point of view. Right, so the important definitions that I believe we have to have a look at. Firstly, what is a lease? Now, this is important because we have to identify what a lease is, so that those agreements that have the characteristics of a lease but are not legally taking the form of a lease agreement can still be correctly identified as leases and treated accordingly. So a lease is an agreement, whatever it is called. It could be an outsourcing agreement, whatever. but it is an agreement whereby the lessor conveys to the lessee. So we can also say where one party conveys to the other party in return for payment or a series of payments. And this is the essence of that agreement, the right to use an asset for an agreed period of time.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.